And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the Hump Day edition of The Real Investment Show. That's right, it's Wednesday as we start to knock out this first week of December already. Interesting story out this morning. There's a meteorite that is going to impact eastern Russia today. Right. So, and it's not huge. It's only between 1 and 4 feet. So, but it's still going to make an impact into eastern Russia today, which is, by the way, this is how the Tomorrow War started, if you've seen that movie with Chris Pratt. Just joking. But here's the interesting part about it. They only discovered this morning, like a few hours ago. So I'm not sure what that says about the future of us detecting meteorites before they crash into Earth. I guess they have to be a lot bigger to get caught, but there we go. So I thought that was interesting news this morning.
Doesn't say much about Russia's early warning system either.
Let's launch a few. So anyway, I just thought that was an interesting news this morning. So again, there is actually a much bigger meteorite that's going to get very close to Earth coming, I think, in like next year. It's going to get like really close, but you'll be actually able to see it with your naked eye. Hopefully it's not like Armageddon. You can watch it all the way in. Deep impact.
Where's Bruce Willis when you need him?
I know, right? Exactly. All right, let's get serious this morning. It is a Wednesday, of course. And so a few things that are going on right now. Economic data is coming in. Economic data continues to do okay. The Atlanta Fed GDP has now upticked to 3.2% growth for the fourth quarter. Now, you've always got to take that with a little bit of grain of salt because they are just kind of measuring real-time inputs that are coming in and they're making assessments on GDP based on those inputs. But we've got ISM services today. We've got a lot of other data coming today. Should be okay. Retail sales over the Black Friday holiday were okay. They weren't astounding, but they weren't terrible. So, it's the consumer kind of keeps on kind of grinding along here, doing what they're supposed to do. That's supporting economic growth. Auto sales continue to do okay right now. So again, some of the kind of important gauges of the measure of consumer health continue to show that it's okay. No sign of recession at the moment. Right. And again, this has been one of the kind of the big concerns over the last couple of years is there's a recession. Recession's coming. And as we've talked about previously, the problem with the recession calls was, first of all, everybody was expecting a recession back in 2022, and it didn't happen because we had all this money in the system, right? The IRA Act, we had the CHIPS Act go on. And just all that money, all that government spending got put into the economy, and that's kept the economy really kind of humming along here for the last couple of years. Now, that is changing, and we'll see what happens in the next, couple of years with government spending. But government spending is a big driver of what's been happening in terms of economic activity. But overall, the inputs are okay. There's nothing out there right now suggesting a major economic downturn. The economy keeps kind of grinding along here at 2.4, 2.5% for the year. That's about probably where we're going to wind up for the year. Next year, we'll start getting some revisions to the data. So we'll probably see a bit of a reduction in some of these economic numbers we've seen over the last year. I think we'll see those kind of ratcheted down a bit just because they generally get overestimated. And when we do these revisions to the data, they tend to get revised lower. But again, that's just kind of the way things go. And nobody really cares about revisions, but we'll see that. But I don't think there's a big risk of a recession anytime soon, just given where we are economically. And again, a lot of this will depend, as we talked about, on the show yesterday, and we'll talk about some more next week. A lot of this will have to do with government policies next year, particularly on spending, right? Deficit reductions. While a lot of people are wanting, we've got to reduce the deficit, we've got to cut spending. That's great. I have no problem with that at all. Don't think I do. No problem with cutting debts and deficits, but you don't get away with that unscathed because that government spending has been supporting a lot of economic growth. And again, there's nothing wrong with that, but it's just for every action, there is a reaction. And so if we begin into a really kind of, aggressive spending cutting program in government, that's going to have an impact on the economy and on the markets, of course, as well. So again, but right now, there's no concern of that. And again, we're just assessing what might come next year. We don't know. And this is always the problem with future predictions, is that we don't know exactly what's going to happen for sure. We've had presidents before talk about cutting spending. Oh, we have to cut spending. And we don't. We actually just keep increasing the deficit and the debt. So again, what's said and what actually gets done are two very different things, and the impact on the market will be determinate on that because that will impact earnings. But right now, as I said, everything looks fine going into next year, and we're going to kind of continue just to play this game for now. Investors are very, very exuberant. Very exuberant. In fact, we've got exuberance to levels that we haven't seen in quite some time in terms of asset allocations. Professional managers are very long equities right now, and there's a potential issue with that, as that we've talked about before, is that when everybody's kind of all on one side of the boat, you typically have something happen that reverses that process temporarily. But for now, again, there's wrapping up this year, there's really not a lot at risk in the markets at the moment. We still have stock buybacks, $6 billion a day going into the year. We've got window dressing coming up here shortly. So again, that's all going to matter. But here's what you need to know before the bell, talking about the rest of the year and kind of what to expect in your market playbook for the S&P 500. So here's the market for this year so far. Doing great, right? Just kind of the steady uptrend, running right along the 20-day moving average for the most part. A few tests of the 50 and the 100-day along the way, but for the most part, the 20-day moving average has been the nice rising trend line of the market. Very low volatility this year. But as we start to get ready to wrap up this year, which is just right around the corner here, expect this market to have a bit, and so far, right, as we've moved into December, we're playing right on book. Markets are up today. That's kind of right in the playbook. The first 5 days of December tend to be positive days. And so you get a little bit of a rise early in December. Then we're going to have a correction that'll probably come down here towards the 50-day moving average. We'll see. But this generally happens between about the 8th and the 15th of the month. And right around that period, we get a little bit of a dip in the markets. And again, it doesn't have to be dramatic. Could be just back to the 20-day as well, but just don't take the size of my wiggle as any indication of what I expect. It's just I'm drawing. But expect a bit of a pullback here in the markets. And then we get set up for the year-end window dressing, where portfolio managers are going to try to put the best positions on their books for the end of the year. They've got to make sure they're fully allocated. So you get this rise into the end of the year. That's the Santa Claus rally that takes you into the first 5 days of January. So expect a bit of a pullback here over the next week or two, a little bit of sloppiness. Again, markets right now, very overbought on multiple levels. So again, just a bit of a correction to work off that process will be needed to have that rally into year end. So again, a little bit of a correction here to work off at least a little bit of some of this overbought condition will help support that year end rally into the end of the year. So again, just kind of expect a little bit of sloppiness over the next, after we get through this week, the next week and the week after, expect a little bit of sloppiness. Now, does that mean it has to happen that way? No. This is what happens on average in both presidential election years, on average, going back through history, as well as just every given market year, going back through history, going back to 1950. That's kind of the average pattern that occurs. It doesn't mean it happens every year that way. Markets could rally just straight on into the end of the year. It's certainly possible. Could have a much bigger correction. That's happened before as well. But on average, you tend to have a little bit of a pullback and then a rally into year end. Outside of that, the rest of the market just kind of continues to perform accordingly. And again, whether it's the NASDAQ, whether it's the S&P, they all pretty much look the same right now. Lots of bullishness across the board. NASDAQ breaking out to new highs. The S&P's had 50 new highs this year so far. So again, just really kind of pushing a very extended stretch of new highs for this year. And again, that's all bullish right now, but I do expect a little bit of volatility in the year. And next year, we'll start talking about after the first of the year. That's a whole different ballgame. So we'll talk about that when we get there. All right, that wraps up. That's what you need to know for the. That's what you need to know before the bell this morning. I'll spit that out. When we come back, we'll pick up with Danny, talk a little bit about portfolio rebalancing and doing the kind of actions to take here before year end. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Save the date now for the RIA 2025 Economic Summit, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Leibowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Watch for registration details at realinvestmentadvice.com. Save the date now for the RIA 2025 Economic Summit, Saturday, January 18th. realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show this morning. Danny Ratliff joining me as well. Him and his bad back this morning. Getting older, are you? Join the club.
Yeah, getting older.
You know, it was so good when we were young. You could just go out, you could just play sports. It was awesome. You know, maybe you got a little sore the next day. That was about it. Now you go out, you blow out your knees, you throw out your back.
Yeah, my dad always told me, he's like, you go way too hard in most things in life. You should probably tone it back. You're going to pay for it someday. It's like, nah, it'd be great.
Yeah.
Yeah,
be fine.
he's sitting back laughing.
Yeah.
You idiot.
No, it was funny when I used to compete in martial arts. You know, many years ago. My dad was a professional tennis player, and back in the 50s, and he played Pancho Gonzalez and all those guys. And as he got older, his knees were just completely shot. Just running on concrete and all that for all those years, and didn't have great shoes back then, right? It was more like wood planks and leather straps, those type of things. Back in the days when we still chiseled out messages on stone tablets. But he told me, he said, because when I was fighting, it was full contact, no rules. So, I mean, people were just kicking knees and breaking joints and all kinds of stuff. And he's like, you're going to regret doing that as you get older. So I retired early from the sport because I saw him. I was like, yeah, I don't want to be that way.
Yeah,
but
I bet not.
Yeah, but even still today, I mean, I even as long as I did it, I'm still paying for it today. My knees are.
Yeah, of course. Anything like that, especially contact sport, it's easy to have things linger.
Yeah. If the things that I knew today that I knew back then, right? So type
thing. But life would have been pretty boring.
So what are you getting for Christmas this year? Coal?
Probably.
Yeah. Well, we should get together and light the grill.
All right, let's do it.
Okay, good.
Yeah.
All right. All right, a couple things to get into this morning. We are starting to get into the end of the year, and one of the issues that's coming up here, and again, I just talked about this a second ago, that we normally have this bit of a pullback that occurs in the second and third week of December as we get into get into Christmas. There's a couple of reasons for that. First of all is mutual fund distributions. One of the things that we haven't really talked about yet and could be a bit of a bigger issue going into the end of the year is portfolio rebalancing. And this is something you should consider doing, and we'll talk about this with Danny in a second, but also something that could impact the overall market because bonds have been laggards this year, obviously. Rates have been high. Stocks have done exceptionally well. So if I'm a buy and hold investor, right, and say I just buy, I'm running a 60-40 allocation, we're constantly kind of rebalancing our portfolio, so this isn't a big issue for us. But if I'm running a 60-40 allocation, as I get ready to go into the year end, I've got to rebalance that 60-40 allocation, which means I've got to sell stocks to buy bonds. That's going to potentially put some additional pressure over the next couple of weeks as portfolios start to rebalance for the end of the year. But this is something that also too, as we were talking about, and this is just from a good portfolio management standpoint, really just kind of a risk management standpoint for investors in general. This is something you should look at. There's a couple of caveats to rebalancing that we'll talk about this morning. But Danny, just wanted to, as we get ready going the end of the year, I mean, investor froth is very high. We've got a lot of, I just wrote an article on Tuesday about leverage and speculation, just people piling into 2x levered, single stock ETFs, just kind of going crazy here, but, kind of what are your thoughts here?
Well, that exuberance is high, just like you mentioned in the first segment. And unfortunately, it's a difficult thing when we feel really good about markets to actually take those gains. I mean, how many people do we visit with that have astronomical gains? I mean, really done well, right? Bought Apple back in 2006, NVIDIA, 10 years ago. And it's been fantastic. But along the way, you need to start taking a little bit of that, harvest the profits there. And the question is for many people in the old school 60-40 portfolio, we'll pick on that. And people say, okay, well, we're going to, a lot of firms will rebalance every quarter or rebalance semi-annually or annually. And unfortunately, it forces a lot of times just to be done automatically, and it'll sell your winners and buy your losers. And that's not always what we want to do, right? We want to make sure that we're not just going to blanket invest because that's what the old school modern portfolio theory tells us to do,
right,
that was written 50 years ago.
Right.
We want to be a little bit more thoughtful than that. But we also want to say, okay, well, if there is something we still have a high conviction in and maybe hasn't done as well, then it's okay to store some money there, to put funds aside. But if you don't, I think it needs to be looked at a little bit differently than what the common approach is, where it's just, okay, we're going to take all the profits from the stocks, buy all the bonds, and that may not be what you need to do.
Well, and not necessarily, and again, that's right, that's the straight point, but it's also just within the stock portfolio itself.
Correct.
If I'm just running a 100% equity portfolio, and this, and again, I kind of talked about this either yesterday or Monday, I can't remember, but I think it was with John yesterday.
It was yesterday, yeah, diversification.
Yeah, just talking about diversification. But even if I'm running a diversified portfolio that's all equity, right? Do I want to take money out of the S&P and go buy emerging markets, which have been dogs for 10 years now, actually 15 years, right? And so the question is yes, you want to take profits, but even within your own equity allocation, you don't necessarily want it to invest in underperforming assets that have been underperforming on a consistent basis because of economic reasons. And if you take a look at economic growth in Europe in general, and particularly in emerging market countries, they're not growing. And if you take a look at where economic growth is happening, it's here in the U.S., and that's why we've got a little bit higher rate of inflation than what's happening in the rest of the world. The Fed's not cutting as aggressively as other central banks are right now. We'll get there, but we're not there yet. But there's a lot of risk of recession in other parts of the world, and so I see a lot of these, investment analysts come out. It's like, oh, well, the U.S. is really overvalued, so go buy emerging markets because they're super cheap.
That's the big talk.
They're cheap for a reason, and they've been mega laggards for 15 years. And so we were talking about this with John yesterday. Is like, so great. I sell the S&P, which is growing, and they're growing earnings. And the big important part about this is, if the S&P was going up but earnings growth wasn't, then that would be a different issue. but earnings are growing, and they're growing pretty rapidly in the U.S. compared to the rest of the world. So I don't necessarily want to go buy stuff that's just going to add a boat anchor to my portfolio. So when I do my rebalancing, the point about that you're making, and it's the right point, is to be careful about your rebalancing. Just don't willy-nilly just sell your winners to buy effectively your losers without a reason for doing so.
Yeah, those losers may be losers for a specific reason.
Yeah.
And it may be time, the other thing I think that people don't do often enough is that sell the losers. They may keep, most people want to take those profits, and while we do agree with that, but there's a time you need to cut your losses as well. And, we talked about tax loss harvesting about a week or two ago. That's something that everybody should be looking at towards year end. If you don't have carry forward losses, it's a great way to offset any capital gains you may have already taken. You can also, there may be a time where you don't want to take capital gains, but you want to go ahead and take a loss and carry it forward. That's not as important if you're not offsetting something in this current year, but something you can certainly utilize in years to come. And we've talked about how many people don't quite understand that carry forward aspect of it, that you can write off an additional $3,000 against your taxes above and beyond what you're going to offset from a capital gain perspective. But anything in addition to that, you can carry forward to the next year and the year after. So, you have quite a few years that you can utilize that. So don't forget to think about that when you're making those types of decisions. And like you said, Lance, there's things that are down, and it may be time to cut bait on those too.
Mm-hmm. Yeah, and again, this is part of the portfolio management process. And again, and just to go back real quick, portfolio rebalancing is very important, right? And you should do this on a regular basis. We kind of do it all year long. We're constantly kind of measuring our portfolio. We look at our target weights. We have target weights for each position within a portfolio. So when things get really overweighted relative to their position, we trim them back to where they should be. So we're constantly, kind of doing portfolio rebalancing. But when we sell something, we don't turn around and just buy immediately something else. Part of your portfolio rebalancing can simply just be trimming back and rebalancing your equity portion of your portfolio that's working and putting that money into cash for now, until you have an opportunity to put that capital back to work. And this is part of the problem with, again, when you look at kind of more buy and hold stagnant portfolios that are stocks and bonds as an example. And it's just, buy stocks, sell bonds, vice versa. You don't get that active kind of ability in that process to maximize where you're putting those dollars to work. And as we talked a little bit about yesterday, is that we want to make our dollars go out to work every day, give them little hard hats and lunch bags, and make them bring home money. That's their job. And that's what we want to do within our portfolio as well.
Well, and I think you need to also think about this time of year. It's also, we've talked about, Richard's talked a lot about goal scooping is what he calls it, where if you have goals for next year, we had a great year in 2024, maybe go ahead and start either allocating those funds towards cash, going ahead and freeing those up. Especially if they're in a retirement account, you may not want to make that distribution quite yet, but also take a look at your taxes. Understand if you can take a little bit extra from there, go ahead and get those funds set aside while it's not as, if like you said, we want those funds to work hard for us. I think that's where people struggle, saying, okay, well, I'm going to need these funds in 6 months. We've got time. Market's going to keep going up. Well, that's great, but what if it doesn't? What if it goes down? So go ahead and start thinking about how do you allocate those funds to prepare for upcoming goals in 2025? What are those needs, objectives going to be? And this may be a really great time to go ahead and free some cash up.
And no, JP, just because I wear a jacket does not mean buy CVS. I will never buy CVS again. Ever.
I don't believe you.
I may never buy CVS again.
You sound like somebody else has been talking a lot on television.
I know. I've just got burned 3 times in a row. I learned
wait. You're not going to follow your own rules here. Hang on.
Right. I'm just saying.
We'll buy CVS again. Someday.
I may be dead. All right. Be right back after the break. Don't go away.
the Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Save the date now for the RIA 2025 Economic Summit featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Leibowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Watch for registration details at realinvestmentadvice.com. Save the date now for the RIA 2025 Economic Summit. Saturday, January 18th. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
My wife put up Christmas lights this weekend, so she's very excited now. But she's very upset at the same time, Brent.
Why is this?
She ordered another Christmas tree for the house. Showed up at the house, she set it up, she goes, honey, this tree's not big enough. We need another one. We'll have one on one side of the fireplace and one on the other. And I'm like, no, we're not. One tree.
The Real Investment Show podcast. Same show, your schedule.
Needless to say, I slept on the couch this weekend
at realinvestmentadvice.com.
The saga of Christmas trees in my household.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, just kind of wrapping up that last conversation about portfolio rebalancing. Just this is a really good time of year to do that. And one of the issues, and this kind of feeds into our next topic about being contrarian. One of my things that I've been a longtime investor about is being more of a contrarian, right? Trying to find the areas that of the market that people don't like. I look for oversold areas of the markets that are out of favor, those type of things, and try to make investments in those areas and catch those rotations within the markets. I like, and we talk about this a lot on the show, is that when the markets are really, really overbought, that's why we get a little bit more risk conscious within our portfolio, because typically that's just how markets work. And so I kind of I lean towards that contrarian nature to a degree, and it serves me well over time, except when I'm buying CVS. So, one of the issues that I've been a longtime investor about is being more of a contrarian, right? Trying to find the areas that of the market that people don't like. I look for oversold areas of the markets that are out of favor, those type of things, and try to make investments in those areas and catch those rotations within the markets. I like, and But, those things happen, right? And just because you're contrarian doesn't mean it always works. And what's interesting is that this market over the last 2 years, and this has really been since October of 2022. So back in October of 2022, so we're in this market decline, and I wrote articles back then saying, hey, I think we're close to the end of this decline, and we're going to have this bear market behind us. And that was based a lot on that contrarian view because everything was so negative, right? Investors were extremely negative. Sentiment was very negative, and those are great setups. And in fact, I'd been on Fox Business a couple of times back then talking about that very thing. And they're like, well, why do you think this market's going to rally? It's like, because you have such extreme negativity. Those are great setups for a rally in the market. Well, we've had a rally in the market for a couple of years. And so now it's time to become a little bit more cautious as we start heading into 2025. But one of the issues of being a contrarian is that just because you're contrarian in nature doesn't mean you should be super bearish, right? The market's up, so I'm just going to short everything. And, or I'm going to be out of the market because this market's going to crash eventually. And eventually it probably will. The problem is the timing to get that right. So, I'm a contrarian by nature, but I also understand that I have to invest within the markets and make money when we can. So there's part of that. But again, one of the interesting things that's been going on for the last couple of years, and one of the things that Danny has been supporting this rally in the market is the contrarian side of this coin, which coming out of 2022, there were a lot of people very bearish on the markets, had a lot of short sellers in the markets, and the reversals of those positions have been a big support for the rally in the market over the last couple of years.
Yeah, which is so interesting because most people find that counterintuitive, right? You got all these people shorting and betting against it, but yet they have to cover these shorts, which therefore means they're going out and purchasing that stock.
Yep.
And prices are continuing to go up. And that's, I think, the main question we're getting right now is like, what do we expect for 2025? We've had all these things occur. You mentioned $6 billion a day in stock buybacks. We've got, today the Fed, Jerome Powell's coming out. Who knows what he's going to say? I think CME Fed Watch Tool says, 72% chance that we see a 25 basis point cut. But there's a lot of things that are unknown. I mean, we're still getting cabinet picks for the Trump administration. What can they actually physically get done? I think there's a lot of, people are, I'm not going to say euphoric, but they're optimistic, thinking that, okay, deregulation is going to help corporations. If they can actually get a tax code done to reduce taxes on corporate taxes, that would be good as well. But I think it's going to be a harder road in front than most people expect.
Yeah. And again, I like I said, I kind of lean towards that contrarian side. So I'm looking for things that are out of kind of consensus. And right now, everybody is super bullish about 2025. If you take a look at the average analyst prediction for next year, they're expecting between 9 and 11% returns in the markets next year. B of A just came out yesterday. They're predicting the market hits 6,666, which is 6,000 points higher. We're talking about this yesterday. That's a 6,000 point increase from the 666 level low in March of 2009. So, it's a nice marketable number, right? So the 4 6s, but if you take a look at the number of people that are selling short right now, shorts against the S&P are almost non-existent.
Yeah.
Nobody's short the S&P. Volatility is very low right now and declining. Though, and sentiment in terms of investor sentiment, we talked about this in yesterday's article. Consumer sentiment about stock prices over the next 12 months, highest level on record. Never seen household allocations to equity, highest level on records. So from a contrarian base, Danny, this really is a good setup for a market reversal at some point. Now, I'm not talking about a crash. I'm not talking about the world coming to an end here. I'm just talking about a disappointment potentially next year versus the average consensus, because when everybody's on one side of the boat, it doesn't take much to start a market reversal. It just takes one guy to go, you know what, I'm out. And then a few other people go, yeah, I'm out too. And then all of a sudden you get the stampede to the other side of the boat.
Especially if you get somebody big with a big voice that goes on there. And the issue that's a lot of us have to remember that they're talking their book many times, right? Mm-hmm. They've already done something, so they're telling everybody this. So then inevitably we all think, oh, wow, okay, we need to do this as well. But there's always two sides to that coin, because if you're going to go short, somebody's going to have to be on the long end,
Right.
And vice versa. So that's where, having that approach where you actually, have a plan, I think is number one. That's the key. But two, I think we need to put things in perspective. This year was a much better year than many anticipated, right? Think about all the pros and cons. I talk about this often with clients. Like we can write a pros and a cons list, and almost every single time that cons list is way longer.
Yeah.
Right. But the market knows about all those things that we're thinking about. So I tell everybody what keeps me up at night, and what I'm thinking about if I'm laying in bed is like, what is it that we don't know?
Right.
What is it out there? Like you talk about the exogenous events, the black swan. Those are the things I think we need to be concerned with. Geopolitical tensions, those have always been there, and they can always, they can ramp up, they can de-escalate. Those are things that will likely, markets will move on that short term, but typically not long term. Unless we get into some major, World War III, that's way different.
Well,
and
maybe,
you get there and it's
but
nuclear,
maybe. Yeah, I mean, if we wipe everything out.
what is it worth? Doesn't matter.
But if we go back to Vietnam or Korean War, World War II, markets actually performed okay. Right? I mean, they weren't
Is that
terrible.
the boost in productivity,
Yeah.
manufacturing, industrial
Absolutely.
complex? Yeah.
So now, when the war first started, it wasn't great, right? But then, during the actual war process, because you're increasing, ramping up production, those type of things.
Well, they're spending more.
And they're spending more. Iraq, Iran, I mean,
But we're doing that
okay.
already, right? So what's
Yeah.
the bandwidth to actually do more of that within the confines of what we've already done? Especially if we have an administration who, quote unquote, wants to reduce the deficit.
Correct. Well, and see, and I think that's and as I was talking about earlier on the show, I think that is the potential risk to the markets next year, which is that the new administration comes in, starts cutting very aggressively, and that government spending has been such a big part of the market and the economy over the last couple of years that all of a sudden that reverses a lot of that corporate profitability. And I think that could be one of the surprises that catches the market is a reversal in corporate profitability because of more aggressive cutting in the government.
Yeah.
And the markets really aren't anticipating that right now. But if there's a risk out there that nobody's really paying attention to, I think that's one of them.
I think it's a great talking point, but how much do you think they can actually cut?
Well,
I mean, you already have 6 Republicans that are going against, basically everything that President-elect Trump is trying to do, and you don't have that wide of a margin.
Right.
So it's going to be very difficult to get most of these things passed.
That's
probably much more so than what everybody's anticipating. I think the issue is we hear the rhetoric and you're like, okay, wow, these guys are going to aggressively go after this. And while that may be the intent, but can they physically get it done is a whole different story.
That's right. And then again, we won't know that until we get there.
Yeah.
Which will be the important part. So, but again, I do think that there's, just from a contrarian standpoint, kind of going back to the contrarian topic, that everybody is on one side of the boat. Everybody is extremely bullish. There are no bears anymore. I posted a graphic out this morning. A friend of mine had posted this on their website, and I thought it was interesting because it kind of really sums up what we're talking about right here. But this was a graphic put out this morning because the bulls are having just a fantastic year, and the bears are just looking for some sort of reprieve at this point, and needing a bit of just a bit of grace from the markets because everything they have, everything the bears have said over the last 2 years has turned out to be absolutely wrong. As the market continues just to crank out higher returns. So again, we'll see what happens. But when everybody is bullish, that is a really good setup for a market reversal.
Yeah.
And what causes that market reversal, who knows? We don't know. It's not anything that we're aware of. It's not geopolitics that you're aware of. It's not Russia. It's not Ukraine. Because the markets know all this. It will be something that is entirely unexpected. Again, and a good example of this, markets are doing fine back in June, July. And then we wake up one morning and the markets are plunging 3% in the morning because of the yen carry trade blow up from Japan.
It was more than that. It was like 6.
Yeah, well, altogether, we were down 8.5.
Yeah.
But my point is that nobody expected that. Nobody saw that coming, right? That's what gets the market. That's what sets up that reversal. What gets us in 2025, and we will have corrections along the way, the magnitude of that is going to be somewhat questionable, is what is the event that causes that reversal, particularly when everybody's on one side of the boat. That's the one big thing to think about next year as you start to think about your risk profile going into 2025. All right, come back from the break, finish up the show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Save the date now for the RIA 2025 Economic Summit, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Leibowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Watch for registration details at realinvestmentadvice.com. Save the date now for the RIA 2025 Economic Summit, Saturday, January 18th. realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
You're listening to The Real Investment Show.
So over Thanksgiving, I had all the kids at the house, and as usual, the conversation starts drifting towards, we kind of reminisce, and the kids, bring up the trips that we took together, and the time they loved going skiing, whatever it was, right? And so they had these conversations.
Hint, we need to go again.
That's exactly right. And so I told the kids, I'm like, that's over. I said, you're over 18 now. You're an adult. I says, as parents, our job raising you was till 18. We took you on these trips. We did these things for you to give you experiences to make sure you're a well-rounded individual and you have skills that you can use in life. But that's over. If you want to go ski with us, that's awesome. You have to buy your own tickets and lift tickets, right? I mean, you've got to start paying your own way. And they were very upset about this. And they go, but what happens if, we graduate college and we don't have a job? I go, that's on you. You can't come home and live with us. We have a spare bedroom in the house. And I talked about this on Monday. There was this article in Slate talking about the 137 million spare bedrooms that all belong to boomers. And we should force boomers out of their house so young people can buy their house and have the spare bedrooms. Yeah, it's Slate. So there you go.
Yeah.
Source is important. But, the whole issue is that, we want our kids to move out, be productive citizens, and they can't have this fallback cushion. But this is a trend we're seeing a lot in the demographics right now. If you take a look at demographics, we have more multi-generational families now living in the U.S. than we've had since the 1940s, coming out of the Depression. You've got the number of young people not having kids,
big demographic, problem going forward. At the, birth rate of children is the lowest level since the 1940s during the Depression, right? If you're in a depression, you don't want to have children, right? Because you can't afford to support them. So that's why you have a low birth rate. But today we have a low birth rate for whole different reasons. But it's interesting because I meet with Danny, I know you do too, but I've talked to a lot of people. It's like, I'm, trying to get ready for retirement, but I'm taking care of my kids. I'm also taking care of my parents. And a lot of the issue that kind of Gen Xers are running into is they're becoming sandwich parents. In other words, they're taking care of their parents, or they're taking care of their kids or their kids' kids in some cases. So there's this more of a pressure on retirement and those type of things from this kind of boomerang generation that we're getting, where kids are leaving and then coming back home and not leaving.
Yeah, I think that's going to only probably get worse. I mean, you think about the savings problem that we have. But one thing I want to know, when did you schedule that trip with the kids?
We didn't schedule one.
Yeah,
there is not one.
You're not going to Utah?
Well, if we go see our cousin Dwayne, it'll be me and my wife. So,
All right.
So
Brent, remind me, we're going to check back in March.
Okay, no problem.
We're going to see if Lance has buckled. But no, but that is a great point, and he will. They're going to, trust me, Christmas is going to come around like, Dad, such great memories. We need to do this again. And
I am a softie.
You guys will all be skiing. You're
I am
fine. You're going to be married with kids before too long. And, but that's a whole other issue, right? So we see so many people right now that are stuck in that sandwich generation. I think the generational gap is shrinking in many ways because we're seeing those homes that just so many people are living in. And while this used to be a lot of ways that a lot of families lived for years, but now it's out of necessity. And that's where it becomes an issue, where we see somebody who's actually supporting elderly parents. And not only that, but then they're also supporting, kids and grandkids sometimes. So you may see 4 generations in one home. And these aren't people that don't have money, or these are, the people that we see that deal with this. So there's people that are, it's really out of pure necessity. But a lot of times it's out of, they've always supported and held up their kids for so long that they don't know how to stand on their own 2 feet. And yes, they enjoy them being home and having that, the discussions around the kitchen table. I think that's fantastic. But it's at the expense of their retirement long term. And that's where I think the boundaries at some point need to be set, so you can say, hey, I love you, but I'm probably doing you a disservice by allowing you to continue to do this. So, set a rule. Hey, if you're going to come home, you've got a year. My dad's rule is you can't come home. You go anywhere you want. I don't care where you go.
That's our rule.
It's just not going to be here. And in hindsight, it worked well. In fact, he's told me he said, I don't want you to take the first job you get. I want you to take the right job. So I tell you what, I have a rental house that is vacant. It's a small little 2-bedroom duplex in a bad part of town. And he's like, you can help me manage some rental properties. He had a handful of these back in the day. And so I was like, great. And he said, but the moment you get your job, you're going to start paying me rent. And I think my first paycheck was like $900. And he was like, what was your first paycheck? I was like, $900. And he's like, all right, you owe me $675. And I was like, what? I was like, Dad, I got to eat. I mean, what? I can't pay insurance and bills. And he's like, you'll figure it out. and I did. And I think it was a good lesson because, you do figure it out pretty quickly. But
I remember getting my first paycheck. It was something like that. I can't remember exactly what it was, but it wasn't much. I thought I was like balling, right? I mean, I was like, look at this. I've never had this much money in my life. And then bills came.
Yeah. And then got that old dad going to give me a deal. Like, nope. Written this thing for this. It's what you pay.
I think it was a fascinating Thanksgiving because it was wonderful having all the kids. So we had all the kids home.
At one time?
All at one time. So all the kids are home from college, and it was great. And by Saturday, my wife and I were both looking at each other going, when are they going to leave?
They are driving me nuts.
Yeah, I know. It was great because it was just like, just constantly having to feed them and keep up with them and, all this stuff. And it was great. I loved having them home. I loved my kids to death. They're awesome kids. But Larry put a comment in the chat. He says, but he says when they live with you, they can do all this stuff for you. Let me tell you how that goes. So over the weekend, my wife wants to string some lights along the back porch of our back porch for Christmas. And so I go, hey, you know what? I'll get my son to do this. He's strapping young man. We've got the staple gun, everything's going fine, and so she's got these Christmas lights she wants, and so she wants to get them hung up. So I said, here, take these strands out there. You and my daughter's boyfriend, y'all go out there and string these lights for them. So they get out there, and as soon as they get out there, they unstring the lights. My son steps on 3 of the bulbs, breaks the bulbs. We don't have any replacement bulbs for them, so we have no lights now. So no, Larry, we don't get our kids to do things. We do them ourselves because we want them done.
Yeah, mine are in a stage of revolt. It's like, hey, I need you to do this. Then like 5 minutes later, you see them somewhere like, did you not hear me? And then, yeah, I'm going to get done. In a little bit. Like, no, it's going to be done now. We have things to do in a little bit. And, and then you replay that for a minute. Yeah. So
anyway, that's where we are in life, right? Like, you're welcome, but please leave.
So are they coming home for Christmas?
Yes. And we will be glad to see them leave.
Now, how long will they be with you guys?
Unfortunately, they're going to be with us for 2 weeks because they're in between semesters. So, yeah. But they have their places to go. So,
well, what you may do is just overwhelm them with chores.
It's a good idea.
Just have a list of things for them to do each and every day. And they're going to be like, you know what, we're getting out of here. We're going back.
Well, they actually probably won't be with us that long because all of our kids have jobs in college.
Yeah,
because they have to pay their own rent and everything else. So so it depends on what the work schedule is. So they may not be with us for 2 weeks, but they are on a 2-week break from between semesters. So we'll see. We'll see what happens.
But I think the moral of the story, getting back to kind of what we were talking about, is that essentially you need to set some ground rules. You need to understand that, any of these funds that you're going to continuously, kind of move towards children, adult children, you're hindering their progress. And unfortunately, you're really hurting your retirement. And so we see this often where, it's, it starts off small, then it's, they need 10,000, they need this, they need a new vehicle, it's going to be XYZ. I talked to somebody a while back and they said, we're going to buy little Johnny a car. And I was like, okay, great. What is it? Well, he said he wants a BMW. And I'm like, what? The kid has no job. He doesn't get to choose what he wants. Like, if this is a vehicle to get to and from a job, great. But it doesn't need to be something fancy. You need to start setting some rules. And the problem is that, many times, especially if you have multiple children, you say, well, I gave this one this much, so I have to go give them this. And then you start trying to make it even and fair, which I'm for. But if it's at the expense of everything else you're trying to accomplish, that's where it becomes problematic. And, I've got plenty of clients that have kids in their 50s that they did this for 30 years.
Yep.
And, if I asked them today, we could have them on the show and they'd say, I wish I would have never started it. Right. Because it's created that environment where it's okay and it's so tough to step back from it. Mm-hmm. And usually one spouse is usually, it's okay, we're going to help them. But when you start factoring it in, it's not just a one-time deal. It's an every single year that you're bailing them out of something, a bad financial decision. They're never going to start making better ones. And then when you run out of money, are you going to live with them? They can't pay bills now.
Yeah. It's interesting, too, is I went to A&M to visit my son. He's in an organization called ABB. It's a business organization. They had an event. And so I went up there for his event, and it was a kind of a parents' night out. And so I met all of his roommates. And it was very interesting because I was talking to all of his roommates. They're all very nice kids. They're all from Katy. They all grew up together out in Katy, Texas. So they've known each other for a long time. But it was really interesting because I've never met them before. But they were all really nice, really polite kids. They all have jobs. And I started asking them the same questions, like, well, who's paying for your college? Who's doing this? It's like, oh no, my dad doesn't pay for anything. And it was interesting because it was just you see that when they have to be responsible for themselves, it creates a really interesting environment for them to where they're excelling. They're doing exceptionally well.
And they want to, because they have skin in the game.
Yeah, and they're doing exceptionally well in school. They're preparing themselves for life. It was really nice to see that. Anyway, all right, that wraps up the show for the day. Appreciate it very much. Danny, appreciate you.
Thank you.
Be back tomorrow. Michael Leibowitz live in studio tomorrow. So we'll be talking about markets, money, Fed, all that tomorrow with Michael Leibowitz. In the meantime, get by the website. His latest article out on the website today as well about the market. So go by there. realinvestmentadvice.com. See you tomorrow.